Thank you. I'm supposed to talk about what is finance today, and so that'll be our topic. And remind me, this is a class on the introduction to business, and you are freshmen. Okay, good, great, freshmen. Okay, let's continue. People break down finance in a lot of different ways. When I think about finance, I tend to think of it as corporate finance, investments, and banking. And if you hear people break it down in other ways, a lot of times people talk about financial services. We can break it down in that way too. But let's keep it simple today. This is the way I think of it. And this is the way that our courses tend to be arranged. Now, I don't know how much you're in the introduction to business. I don't know how much of business you've talked about. I don't know how familiar you are with financial statements. Do you know what a balance sheet is? Is this something you've covered? You can give me signals. Let's go with this for yes and this for no. I've been doing this for years and it works really well. So, no. Okay. This is something called a balance sheet. Accountants create financial statements for companies. And on a balance sheet, on the left-hand side, we have assets. And the assets of a company are the things the firm uses to produce goods and services. That's what firms do, right? They produce goods and services. They produce washing machines and iPods, and they also provide services like banking services, insurance services, cleaning your house services. And so they produce goods and services. So can you tell me a thing that a company might have that helps it produce things? What does a company own? Okay, we don't own employees, but they might be part of goodwill. That might be part of our assets. They hire employees, but give me something else that companies own. Land. And what do they have on that land? What?
Like production
stuff. Okay, production stuff like plants, equipment, different types of buildings. Certainly, insurance company would have office buildings, and drug companies would have laboratories, etc. But these are the things that companies use to create wealth, to create value for their shareholders, for their debt holders, people who have lent them money, and also for society. We wouldn't be a very, very wealthy society if businesses didn't produce goods and services. We wouldn't have much. Now, in finance, we look at the left-hand side of the balance sheet, these things. All the decisions associated with them we call investment decisions. Now, you may think, I thought investments was buying stocks and bonds. Yes, but we're talking about corporate finance. From a corporate finance perspective, we call these investment decisions. And let me give you some examples. Should FedEx or Delta or whoever buy one type of plane from Boeing or a different type of plane from Airbus? Okay, now that's a complicated decision, and it's certainly not just a financial decision. A company could say, hey, we like this plane because it gives us greater flexibility, or for whatever reason. This plane has more capacity. But there's a financial aspect to this decision. That is, maybe one type of plane costs more to buy, but the other costs more to maintain. And it's the finance people's job to figure out, what is this plane really costing us? Which plane makes more sense? And some executive could say, I like plane X better than plane Y. And the finance people could say, that's fine, you like the flexibility plane X gives, let us tell you how much you're paying for that extra flexibility. So decisions, most business decisions are complicated. They don't involve just finance people or just operations management people or just marketing people, but people have to work together, and there's a financial aspect to these decisions. Should we introduce this new product? I have multiple former students who over the course of their careers have had to assess, does this product make any sense? If we introduce this product, will enough people buy it so that it's wealth creating and not wealth destroying? That's a big issue. It's a big issue whether a product is going to make us money or lose us money. And when you think about it, it is a complicated decision. Many years ago, when Coca-Cola introduced Diet Coke, that was a big deal because they already had a Diet Cola. And so finance people had to sit in back rooms along with the marketing people and say, if we introduce this new Diet Cola, how much will that cut into the sales of our other Diet Cola, et cetera? So these are not simple decisions, and they're not completely financial decisions, but there's a financial aspect to these decisions. Should we build this component or buy it? Which makes more economic sense? Almost every business decision has financial consequences and requires finance people to assess those consequences. I want to hold off on that. I want to tell you a story about a Chicago radio station many, many years ago. I'd be embarrassed to tell you how many years ago, before you were born. This Chicago radio station advertised that they were going to go without commercial interruption for 6 weeks. They were going to do nothing but play music and have an occasional news update for 6 weeks. Now, what were they thinking? They were thinking, hey, if we're the station that always plays music, we're going to get more listeners, right? People want to listen to us. They're going to change from their other stations. They're going to listen to us because they don't have to listen to commercials all the time. And so this was an investment decision. It may not look like it. It wasn't necessarily an investment in physical things, but they gave up advertising revenue, all advertising revenue, for 6 weeks. Why? Because they thought they could grow their listenership enough so that they could charge more for their ads after 6 weeks, and that would be a good investment decision. Finance people had better been in the back room running the numbers and saying, yeah, this makes sense. Based on the estimates the marketing people have given us, the amount by which our listenership will increase, the amount we can charge for, the additional amount we can charge for advertising after 6 weeks, we run the numbers, and this will benefit our company. Well, I don't know if it did or not. For some reason, that radio station went out of business. So I'm not sure they had finance people in the back room running the numbers. Okay, let's go to the other side of the balance sheet. Do I have a... No? Just keep going, huh? I only have 13 slides, so don't worry, we won't go too long. Okay, you look kind of tense. You have a test in this course or coming up? You're making me nervous. Could you relax a little bit? Okay, take a deep breath. Okay. I've been facing classes of 60 MBAs for 4 hours this morning. I need to relax a little bit. They can be brutal. Okay, let's go to the other side. On one side of the balance sheet, we have the things that the company uses to create these goods and services. On the other side, we have the way the firm obtains money for the things it uses, for the assets. Every dollar that's spent on an asset has to come from somewhere, right? The company issues stocks, equity, ownership. Those are all three the same thing: stock, equity, ownership in the company. And they also issue debt. They might get debt from bondholders. Maybe you own bonds, your parents own bonds. That's debt. If you or your parents own a bond, that means you have loaned money to a company. You've lent it. You're not an owner, but you're a lender. And or the money could come from, it could be generated internally, right? When a companies make money and they make sales and they have various types of costs, and down at the bottom of something we call the income statement is earnings, also called profit. And that profit can be, two things can happen to that profit. It can be paid out to the shareholders, the owners, in the form of a dividend, or it can be reinvested back in the company and be used to buy these things on the left-hand side of the balance sheet. Now, finance people are very involved in the decisions on the right-hand side of the balance sheet. They're called financing decisions as opposed to investment decisions. And broadly, we might call this capital structure. So what are some of the questions associated with that right-hand side of the balance sheet? Firms raise money to obtain assets by issuing stock, as I mentioned, and bonds. Now, debt comes not only in the form of bonds that they issue, but they can also borrow from financial institutions like banks. They can also borrow directly from an institution, as well as borrowing from individuals or institutions via bonds. How much equity should we use versus how much debt? This is a big issue for corporations, and it's a trade-off. Corporations have to trade off debt and equity in what we call their capital structure, how their assets are financed. And the reason is debt is cheaper than equity in this sense. Firms have to pay. They have to pay their owners. They have to pay their lenders some interest. Debt is cheaper to the company than equity for at least two reasons. One is debt consists of guaranteed payments. Now, guaranteed does not mean you'll get them with 100% probability, right? Because they're guaranteed to the extent that the company can guarantee them. They're guaranteed to the extent the company doesn't go out of business. Okay, so one advantage of debt is the cash flows are guaranteed, unlike a stockholder. When you own stock in a company, you may be getting a dividend stream, but at any point in time, the company can say, we've chosen not to pay a dividend. The second reason is if the company does go bankrupt, if it does experience what we call financial distress, the bondholders stand in line ahead of the stockholders to get paid out of what's left over. So issuing debt is cheaper than issuing equity. So you say, why don't you issue all debt? Well, here's the trade-off. The more debt a firm uses in its capital structure, the riskier the debt becomes and the riskier the stock becomes. And that means as they both become riskier, they both become more expensive to the company. If I'm giving you a riskier security, you're going to demand a higher return for it. Your return is one side of the coin. That's my cost as a company. Does that make sense? I don't want to go into any more detail. This is a big decision. We have to say how much debt, how much equity do we use to finance those assets? There are many associated questions like how much of our debt should be short-term versus long-term? Now, equity is ongoing, right? Equity will last as long as the company lasts. But debt you can borrow money for 90 days or a year, or you can borrow it for 30 years. I had a friend many years ago who had 40-year bonds issued by a corporation. They'd been issued, they didn't mature for 40 years. How much does it cost us? This is another question associated with capital structure. How much does it cost us, our company, in annual percent to raise money to use for assets? Now, this is called the weighted average cost of capital. And there are many details associated with everything I say today. Remember, I have 13 slides. I can't go into a lot of detail about anything. But this idea of a weighted average cost of capital is very important. We don't apply it to every project, high-risk project, low-risk project, apply the same cost of raising money. But if you're making decisions for a corporation, you'd better know that on average, it takes us, 12% return, 12% interest to raise money. Because that means our projects, on average, better earn at least 12%. If it costs me 12% to raise money, my projects better be earning at least 12%. Otherwise, I'm destroying value. I'm not creating value. Are you following me? Am I making any sense? So this is a very important number. We call it weighted average cost of capital. A lot of details associated with how we apply it. Again, you wouldn't apply the same hurdle to a very risky project as you would a low-risk project. And here's an issue we have to decide. I said that when a company makes profits, it has to decide what fraction of those profits do I pay out to my shareholders and what fraction do I retain? I invest in the name of the shareholders. Do I invest in buying more stuff, more assets, more buildings, more land, etc.? I have to make that decision. And that's not an easy decision. Notice, none of these decisions are simple. Okay. Let's go to investments. We've talked about some aspects of corporate finance. Let's talk about investments. I just want to throw up some questions that we address in our investment courses. And one of them is, what methods do investors use to try to pick good investments? How do investors try to say this stock is a good stock, that stock is a bad stock? Now, one of the really unfortunate misconceptions is that business people are a bunch of greedy people who are just trying to make money for themselves. Nothing could be further from the truth as far as I'm concerned. Just like when a corporation, if we think about corporate finance, if a corporation can take $4 of assets and it can make a $5 product, it has created wealth for society. It took $4 worth of stuff and it turned it into $5 worth of stuff. That's good for society. That's good for shareholders. On the investment side, we want investors to be able to pick undervalued investments because obviously that's good for the investor. If I find a stock that's selling for $10 and it really is worth $14, I buy it for $10. Pretty soon, we hope the rest of the market catches on. It goes to $14 and I make money. But in my action of uncovering undervalued investments, I tend to force their price up to where they should be. We want companies that have good prospects to find it easy to raise money. If I can find, as an investor, if I can find those companies, I bid up their prices. I and people like me who say, "Oh, this company's undervalued. Its price is too low." We buy them up. We force their prices up. Those companies with good prospects find it easier to raise capital. They find it easier to raise money, and we want that, right? We want good companies to find it easy to raise money. Companies with good prospects. So this is good for society if we price things what we call efficiently. So one of the things we study is how can we identify stocks that are undervalued and overvalued. I just mentioned something called efficiency, and efficiency can mean a lot of different things, but we have a very specific term called market efficiency. And basically, the issue of market efficiency is how smart our stock prices or how smart our bond prices. And the acid test is always, is it easy for an investor to beat the market? If it's easy for an investor to beat the market, then prices aren't very smart. In a well-working economy, we want a stock market that is pretty nearly efficient. That is, it is pricing things properly. These active investors help us to price things properly. Now, it turns out that it's not that easy to beat the market. And by the way, I'd say for every 10 people who tell you they can beat the market, that is, they can earn higher returns than market averages over time, maybe one can. Maybe one can. It's you saying, "Oh, my uncle beats the market all the time." Maybe, maybe not. People have selective memories. They tend to focus on their successes and not their failures. It's not easy to beat the market. We conclude the market's pretty efficient. Prices are pretty good indicators of value. How should investors optimally split their money across investments and asset classes? We call this portfolio theory. It's something we study in our investment classes. How can derivatives, can anyone tell me what a derivative is? Oh, futures and options. How about that? They're called derivatives for a reason. They derive their value from an underlying asset, like a stock, or it can be something else. And so here, one of the things we study is how can derivatives be used? Derivatives can be used very effectively to reduce risk. Now, you may have heard, "Oh, derivatives are evil, they're bad, they cause problems." They can be abused, and they certainly were abused in the financial crisis. You can use derivatives in very safe, risk-reducing strategies. You'd learn that in investments, and you'd also learn that in options and futures. Let's talk just a little bit about banking. I've taught corporate finance, I've taught investments, I've never taught banking. So I think that's why I give it one slide. Okay? Commercial banks, you probably know, I guess I could read these down here. I don't have to keep looking up, right? I look like I'm looking at your boots. They're very nice. I like those. Commercial banks tend to take deposits and make loans. What are the loans? Mortgages, other consumer loans, and business loans. Okay, that's basically what we think of when we think of a commercial bank. Some of you might be interested in investment banking. Now, just the fact that you work for an investment bank means you could be doing corporate finance, you could be doing investing, or you could be doing the traditional investment banking functions of issuing securities. That's what most of us think of. We think of investment banking. How do these firms issue stock? How do they issue bonds? Big companies almost always go through an investment banker. Actually, small companies too. If they're publicly traded, they're almost always going through an investment banker to help them to issue securities. these same companies, the investment banks like Goldman Sachs, JP Morgan, et cetera, they all also do a lot of other things. They provide a lot of financial advice on a wide range of topics, and they're often involved in the actual trading of securities. Now, when you or your parents or your friends buy and sell stocks and bonds, somebody has to facilitate that. And various people are involved in facilitating it, carrying out those transactions. They often, but not always, work for an investment bank. I just want to talk generally now. I told you I have 13 slides. We're up to number 9. We discuss a lot of interesting issues. Consider the hedge fund long-term capital management. This is ancient history to you, but I have a nice picture, so I'm going to show it. If I had a nice picture for some of these other companies, I'd use some of the more recent ones. But here's a plot of $1 invested in March of 1994 in a hedge fund called Long-Term Capital Management. Long-Term Capital Management was able to turn that $1 into $4 of value over a 4.5-year period. Now, that's a really good return. It's something like 40% a year. And notice how stable it is. It's a pretty not a lot of risk in there. It just went up like that. So we study companies like Long-Term Capital Management to see how they did this. But we're even more interested to study them to see how they did this. They lost everything they made and more in a very short period of time. So to finance people, that's interesting. The fact that you can do so well for a long time and then do much worse. I mean, look at the value here. It actually should have gone to 0, but the United States government stepped in, as it has done recently, and said, ooh, we don't want long-term capital management to destabilize the financial system, so we're going to form this consortium of banks, which is going to help them get out of this mess. Okay, we find that interesting. What else do we have? AIG has done this more recently in a very different way. Interesting issues. AIG was America's largest insurance company. What was a small AIG office in London doing that destroyed all of its value? This is another company that would have gone out of business, but the United States government said, uh-oh, we can't let this happen. And they stepped in, and they paid off a lot of AIG's debts. What is the recent financial crisis? What caused it, and how did it turn into a major economic recession? This is something that finance people and others, such as economists, study. Okay, additional interesting issues. Anybody recognize this guy? Anybody know this guy? You're nodding. You know that guy? Warren Buffett. Warren Buffett. And it says, who is this man and why should we care? Or maybe I should ask, why is he smiling? Hint. Last year's Forbes magazine listed him as the, as the world's 3rd wealthiest person. So I don't know if that's a reason to smile, but Warren Buffett is. I told you that the market is pretty close to. It's nearly efficient. It's hard to beat the market. Here's a man who's beaten the market on average for about the last 50 years or so. So he's somebody we find interesting. He's somebody who's done a good job of creating value. Okay, let's finish up. Oh, you know I'm close to the end. Slide 12. Last year's 224 finance majors took jobs with over 80 different employers. Now, I don't know if Fred Middlestad has talked to you, but contrast this to accountancy, where accountancy majors a lot of them go to the big 4 firms. A lot of their graduates go to 4 different companies. We don't have any companies that dominate. I'm not saying either one is good or either one is bad. We're just different. And this list of companies changes every year. I had this slide from last year, and I had to change it. PNC, which is a regional bank, hired 6 of our graduates. Then we have GE, a consulting firm, Ernst & Young, this is mostly consulting for Ernst & Young, and then Citigroup. So our graduates are spread over a large number of companies. I think around 80 companies hired finance majors last year. Let me bottom line you, and this is my opinion, and I'm biased because I like finance. But I think that finance is a good major for some. Finance is not for everyone. You know, thank goodness we have people who want to be marketing, human resources, accountancy, operations management. Business needs good people in all fields. And your job, if you want to go into business, is to say, where do I best fit? where am I going to be happiest? Where am I going to be most productive? Where am I going to be most successful? And it may be finance and it may not. My assessment is that there are many good majors. Picking the right major is all about finding a good match for you. I never try to sell people on being finance majors. You have to make that decision. I may sound like it because I like finance, right? I've been doing finance for a long time. I've been teaching finance for over a quarter of a century, almost 30 years. Are you generally comfortable with working with numbers? Finance people don't have to be hardcore quants. That is not true. But you have to be at least somewhat comfortable with numbers. Do you enjoy solving problems by thinking analytically? We're not talking about high-level calculus. We're thinking about solving problems by thinking through them logically. Do you enjoy that? Are you able to live with some uncertainty? And I would add, because in finance we're guessing, right? Business is guessing. We're like marketing. How many people are going to buy our product? We're making predictions about the future. And so you have to deal with some uncertainty if you want to be, I would say if you want to be a business person. But certainly if you want to be a finance person, we're making predictions. I think this is the end, but let me add that the vast majority of finance people, not all of them, but the vast majority of finance people work with other people. They work with people in other areas. They work with marketing people. They work with operations people, etc. So I think in most finance jobs, it is an asset, it is a benefit to be able to work with other people. I think that's true of most of business. In investments, you can probably find a job where they'll stick you in a room and you can just crank out your analysis and come out occasionally. Okay, I think that's all I have for you. And I think, do we open it up for questions? Okay. And by the way, it won't be that hard to stump me. Let's take that challenge off the board right now. So go ahead.
As far as financial positions in nonprofit organizations,
yeah.
What are the possibilities with that? Are they
I would think.
Similar to like corporate organizations, or
say that again.
Is it similar to like a corporate organization?
Yes, we have, as you may or may not, the question involves finance people working for not-for-profit organizations. And I am not an expert on not-for-profit organizations, but as you may or may not know, we have a master's degree in not-for-profit business in this building. And I would talk to them. I would talk to the people who run that program. But as a finance person, my belief is every business, whether you're for-profit or not-for-profit, should have financial analysts, because the not-for-profits are making investment decisions. We've certainly talked to people in various aspects. I guess I was going to say there's this thing called microfinance, which can be not-for-profit or for-profit, but certainly, not-for-profits don't want to invest their money badly. And I don't mean just stocks and bonds, but I mean their investment decisions. Not-for-profits have assets just like for-profits. And so your analysis might be somewhat different, your focus might be somewhat different, but not the principles that you learn. I would say it's just as important. That's my assessment, but you can certainly talk to the what do we call it, M&A program in this building and see what they say about finance. I think they'll tell you it's important that they have good finance people. Okay, other questions? You're gonna let me off the hook? I've only been teaching since 8 this morning. I've still got some fuel in the tank, so I appreciate you letting me off the hook. So thank you. You've been a great audience, and